Mr. Chris Frostad. How are we, sir?
Very good, thanks, Matt.
Glad
Good to go.
to hear it.
Yeah.
Good weekend? Good weekend? Speaking to the guy at the other end of this call. Did you have a good weekend?
I had a great weekend. Well, no, we just talked about our weekends, so it's relatively good. You know, we were
Relatively good.
we were working, helping our kids out, doing things, and that's always good.
Good.
It's always
good. I thought the attention span had waned somewhat there. Couldn't even get to the end of the question. Okay.
Yeah.
Right. Okay. We're firing on all cylinders today. And in fact, we're firing on all cylinders because we're going to talk about a subject which is a very emotive, it's a very evocative subject, and we certainly get lots of complaints, insights, thoughts on the matter from disgruntled shareholders, and some happy ones too, it has to be said. And we're going to talk about the spending behavior of junior exploration companies. Oh boy, here we go.
Right.
Here we go. So
Brace yourself, folks. Yeah.
Brace yourself, folks. And by the way, I think we should get a decent response from this. People do send in your own experiences, stories, thoughts on this. No thought is a bad thought. It's just how you feel, and that affects your decision making when it comes to investing and not so. Would love to hear about it. But look, why don't you maybe start off and throw some headline, quick punchline type numbers at us to kind of get the ball rolling.
Well, I spent a little time because I knew we were going to be talking about this, looking at a bunch of companies. So we've pulled up the financial statements on about 19, 20 junior exploration companies in the uranium space. Might as well talk about the uranium space. That's what we do. And looked at their last annual report, and you see 2 years worth of stuff. So we've got a lot of data that we can speak to and how that spending goes. But I think a lot of people are surprised at how much money that's raised doesn't go in the ground. And in many cases they're horrified where they shouldn't be. Some cases they're horrified and they probably should be. But I think on average, you're looking at about a third of the money that's raised. More than a third of the money that's raised doesn't go in the ground. It is used to run a company. And I think a lot of people need to realize that we're all public companies. Therefore, we are in a regulated industry, highly regulated. And we have to do all the same stuff that a Cameco does in terms of how we report, how we disseminate, what we need to know, what we need to understand, et cetera, et cetera. So there is a big chunk of money, it's about probably $500,000 or $600,000 a year, which is all that does is feed into being a public company. That's not paying rent or promotion or salaries or anything.
And you have no choice, it needs to be said.
We have no choice on this. We have no choice. No.
So let's look at both sides of that argument, right? Where people say, I'm really kind of annoyed by all of this. In fact, let's go way back when. Let's go to how do you list a company? The process involved there. Oh, yeah. My dear Lord. Just going through the process myself, I'd say frustration doesn't even come close to communicating how I feel about this thing, because everyone's got their hands out. You've got to get an accountant. You've got to get a lawyer or two, depending on how many jurisdictions you're in. I'm doing something in Chile at the moment. I've got to have an accountant. I've got to have an auditor and a lawyer in each jurisdiction. UK, Canada, Chile. Pay for that. It's horrific. And they seem arbitrarily to decide in a very punitive way how much they feel like charging you. And it's very hard at the end of it to kind of see what they've done. But I guess they feel they need to cover their arse when it comes to the exchange coming back on them, because at the end of the day, they'll be held accountable potentially. So there's that. And then there's the time component here, because while they're doing their thing, you're still paying people to sit around in the background and wait for them to have done their thing. So it's quite a painful process. I mean, one, what's your experience of it, and two, do you think there's a better way?
Well, it's distracting as well. If you're an operating business and you're trying to do this, it's very distracting to your operation. It depends on whether you've done it before. I mean, there's a lot of I don't want to call them shortcuts, but there's a lot of things you can avoid if you've done it before and you've done it a few times. Because in Canada and on the Canadian exchanges, we do list a lot of small resource companies. There are people that know how to go at it, and I would say it probably costs about if I were to do it, it would cost me $1 million.
Yep.
Just to get listed, and yes, it's going to take you upwards to 6 months to make it happen. Now there is a mechanism in Canada that allows you to put to where they recognize the fact that the people that are taking these things public, the operators, don't necessarily have a lot of experience in the capital markets, and therefore there's a mechanism in Canada whereby you can actually set up a shell company, if you will. You get some directors and you raise the money and the shareholders necessary to take it public, and you put this shell company, get it listed, and then you go and look for a business to roll into it. So it kind of splits it in two and puts all the administrative and a lot of the heavy lifting, gets it out of the way of the operator. But yeah, it's not quick, it's not cheap, it's not easy. You need literally hundreds of investors in that initial raise.
200 now, something like that.
I think something like that. Yeah.
Yeah.
And they each have to put up a few $1,000. You've got to create prospectuses, which are massive documents, and it goes through the review of the exchange numerous times, and they keep sending it back. So yeah, and then you have to, typically you're doing a concurrent financing. So there's all that goes along with it. So it's not a quick and easy process, and it's not a cheap process.
It's not a cheap process. You're right. It's distracting. But just on those listed cash, you can have listed cash shells or private cash shells, which other people have set up. In fact, there's a whole industry around it in Vancouver and Toronto. It seems where people have said, well, at some point, someone's going to want to list something. We could save them a lot of time, obviously positioning themselves rather well in the process, because it is a pain in the ass and it does take a long time. It's 6 months, sometimes 9 months.
Yeah, but you're right. It is a bit of a small industry. I mean, if you wanted to go public and you gave me a call, said we want to take our resource company public, I could make 2 or 3 calls, and there's people that know each other, and they do this together. So they've got a lawyer, and they've got the accountant lined up, and they've got the directors lined up even for you, like whatever you need. We can whip it together pretty quick. It still takes time. It still takes work, and it still takes money. But it's doable.
No, it's doable, but I want to always look. I want to look at the good and the bad of those things as well. In fact, all the things we're going to talk about today. There's always two sides to the coin, and I imagine most people listening, watching or reading this conversation today will sit on different sides of the fence, right? It's just going to happen, right? And I've seen, and I've been felt like this on occasion, where you see that groups who have got these kind of, whether they be private or listed cash shells, position themselves with all the cheap stock, because after all, they've spent the money, which could be, like you say, anything from a couple $100 million, a couple $100,000 million, a couple $100,000 initially just to get the thing set up. But they're sitting on the 1 cent, 2 cent, 5 cent stock.
That's right.
And they can say, well, we're taking that because we've spent the money up front, and we're taking that because we're going to save you maybe 3-4 months of the process. So there's a cost to that. Those are the people that some later shareholders look at and go, hang on a sec, they've got all this cheap stock. How dare they, right? I'm offended. They should be coming in the same level as me. And you kind of go, well, look, come on. You didn't put up a couple, $200,000-$300,000 up front. You didn't go through the process of setting that up. You didn't find the deal to roll into the asset. You didn't vet the deal that goes into the asset, and then you didn't kind of complete that, listing process. So they got to reward themselves somehow. They're not paying themselves salaries. So I think it's kind of reasonable in most cases. There are exceptions of people who have really taken the piss, as we say here in the UK. We're taking the mickey. What do you say in Canada?
Taking the mickey.
Taking the mickey. Do you say it? What do you guys say?
I don't even know what that means. I don't know how to translate that.
Taking the mickey. Well, just being a little bit cheeky and maybe perhaps over position themselves.
They have, well, and you got to recognize it that you're right. They're not allowed. We're not allowed to. I've sat on some of these boards, and we're not allowed to take a salary. Right? It's your job as a board member to go and find a company and find a business and vet it and have done all the work. So you're taking a flyer out of the gate, which is why you're sitting on the cheaper stock. but yes, so you can wind if you're someone looking to go public, you got to watch if you're going to step into a group of people that are going to take you public. You got to vet them very well to see what you're dealing with, because you're right. You could wind up at the end of the day with if 5, 10, 15% of your company stays with them and you think that's a ripoff, well, the other side of it is if you'd done it yourself, it probably would have cost you that much more to make it happen, and it would have taken longer. And so there's a balancing act there, but you have to watch. You have to know who you're dealing with and who you're partnering up with, because you are handing over your assets to to a group.
Yeah, and I think, like I say, go back to that benefit of time. Yeah, yeah. In relationships, time can be a great healer, but in business, sometimes time can be terminal. In the sense that you don't kind of insert yourself into that right time frame, and
That's right.
First mover, etc., is the end of it. So therefore, there's a value to doing something like one of these kind of, well, even RTOs, which sometimes happen. So it's not a case of listed cash out. It's an RTO. You're taking over something which hasn't quite worked so well. But then you're dealing with things like potentially a slightly messy share register, share count, even, and maybe a little bit of hair on the dog, as they say, where you've got some things that previous company may have been known for or been through, which is a kind of a legacy.
There may be out and out liabilities still sitting there,
and liabilities as well, right?
Yeah.
But usually, kind of cleaned up RTOs,
Right.
they do work. And again, speed to market. I think that's what that kind of brings.
And there's people that focus purely on that, on taking companies that have gone under their shells now. They're still out there. They still have hundreds of shareholders, which is the value in them, because that's the hard part to get together. But this is what they'll spend a year or so cleaning it up. And doing the consolidation.
Those are pretty angry legacy shareholders usually, and you've got to tell a darn good story as to why this time it's going to be fine, because otherwise that becomes an overhang. People ready to dump their stock once they're back in the money. Should they be back in the money? And that's I always worry about those things, unless you're really clear that
typically
though, shareholder, right? It's got to be your type of shareholder.
Though, you're seeing that those shareholders have been consolidated into oblivion, so they're not an issue anymore because it's been dormant. You're looking at dormant companies that don't have anything going on. There really is nothing left for the old shareholders.
Right. Okay. If consolidation has happened, once or twice, then I suspect, maybe not so much. But if not, watch out for that, folks. Okay, well, let's look at some of those moving parts. And if people don't mind, again, come back to us on any of these points. If you agree, disagree, it's all good. We're just trying to educate perhaps people who perhaps not into the detail, don't understand it. For those geniuses, of which there'll be many watching, listening, and reading about this, feed into that process. Okay, so one of the things you said was, a lot of the money which is spent on overhead, obviously, therefore, it does not go into the ground. And again, people sort of a little bit disappointed to hear that, because the more money goes on the ground, the more you improve the chance of success. That's out of your control. So is it a case of some companies just don't raise enough money?
Well, yes and no. I mean, if you're looking at a ratio as well, because quite frankly, if I put $2 million in the ground, why is there more overhead if I put $5 million in the ground? And to be honest, there shouldn't be. I mean, there are thresholds where all of a sudden, okay, I need more infrastructure to make this happen. I don't think it's between 2 and 5 million. If I'm going to spend $10 million in a year, okay, I need a few more people on the ground. I need a few more desks for them to sit in. But by and large, I think you're looking at. I think on average, it's about $1 million a year, is what we see junior exploration companies spending on their overhead. And that doesn't include, there's things when you're looking at a financial statement, right? There's, and a lot of people, their eyes will glaze over quite quickly, but most of the items on there, it's difficult to read them, I guess, at the end of the day, because some companies will have 3 or 4 line items, and that's about as granular as they explain what they're doing. Others will have 12 or 15 line items. You can see in great detail what it is they're up to. But even then, you've got some mixing and matching of information. Well, a good one is, most of the CEOs and most of the executives contract in rather than are employees of the business. And they'll do that for tax purposes, or they've got a personal corporate business, or they've got or they're doing other work with other entities. But You'll see that on the financial statement sometimes as salaries. You'll see it sometimes as management fees. You'll see it sometimes as consulting fees. So it's hard to actually sometimes wrap up what exactly is being paid out to the human beings that are running the show. So that can be a little bit confusing. The big number I think that gets confusing is around options. There is, when you look at when you look at a P&L, profit and loss, the biggest number you're probably going to run into is this equity compensation number, which can be hundreds and hundreds, if not millions of dollars. And in fact, it's a non-cash item. It's a calculation. It's called Black-Scholes, and I'm not even going to attempt to explain it. But it's from an accounting perspective, it's a requirement to show some cost attributed to having granted options, whether they're in the money or whether they're ever exercised or not. So, as you're looking at those numbers, you think, holy cow, that's a lot of money going out. You've got to be able to differentiate what's cash and what really isn't.
Okay, interesting. People look, you can look up Black-Scholes model, it's something I don't actually like, because I think there should be much more clarity about how people are remunerated in public companies, and as well with expenses and so forth. Okay, so how the company spends its money, X the operations. So just in terms of the G&A component, I think I'd love to see much more transparency on that one, because I know my expectations of one of the assets I've rolled an asset in, and hopefully that gets over the line end of this month. And my expectation around the management team is around, when they can sell stock, not just, when, there's no blackout, we can sell stock. It's like, no, I want people to be, buying into this for the next 12 months and, not selling to the market. I don't want to see big expense claims. Oh, I had to take so-and-so out for dinner. Did you now? Really? Did you need to do that? In fact, were they actually there? That kind of conversation I see, and I've been the recipient of this early days on, where companies would take me out for dinner and be buying wines like you wouldn't expect, or even one enterprising young CEO said, no, he wasn't so young. I tell you what, I really fancy this bottle of wine, £800, ladies and gentlemen. He said, would you mind paying for this? And you can send me an invoice. I'm like, what the actual effing hell just happened? I just bought the wine, and I did not expense it for him, but that was his workaround. Imagine I wasn't the first or the last person that got asked to do that. And you just sort of see these costs and trips and business class and first class tickets and 5-star hotels and 5-star restaurants, and which is not a whole bunch of money as a percentage, but it is indicative of the mentality that they have. And again, stuff that I've been involved with, it's not just one company, it's multiple companies which I've invested in. I expect people to get competitive tendering, competitive bidding on everything, right? Because you want the best, and you don't have to necessarily, buy the cheapest, but you got to buy the cheapest so you think can actually deliver it clearly. No point in buying cheap and then they screw things up. But that whole transparency, I think if the exchange wants to sort of get involved in some stuff, actually pull their weight, earn their money, that would be a great area for them to kind of, go after. I don't think it's enough. I think these, 2 or 3 line items on the cost of G&A is not good enough. There's all sorts of fun and games, which I've seen, I'm aware of, which I think just sucks, and it just doesn't help, quite frankly.
Well, again, this comes down to the board. Right. I mean, these aren't, you're talking about things that are not going to wind up in a financial statement or an MD&A or something like that. But that's the responsibility of the board. And so when you're looking at these companies, you need to look at the boards. Who have they got? Because typically, they might just be the same pack of animals that are, doing the same thing in another company. So if they got a reasonable board, who's running the show, and what's the history of spending in general. But you're right. I mean, and again, talking about how these statements are presented right now, a lot of this stuff, when we talk, where do you put that on a profit and loss? So you've got advertisement, you've got promotion, you've got IR, you've got travel, and sometimes they're lumped together. Sometimes they're in 5 different buckets. Like you cannot the way it's currently distributed, you can't. There's no investor going to pick that out of a financial statement.
Right. Okay. Let's. Okay. We're dealing with okay. So I'm talking about personal expenditure for their own benefit, which I'm sure the tax people in Canada should be interested in, but it gets hidden in company accounts, right? So that's another. So that's I don't like it. I want more transparency. Then the stuff that companies have got to spend money on. Okay, so it's clear that the things that companies need, they need an experienced management team with a business plan, with a strategy, and the cash to be able to kind of deliver that strategy. So experience, access to capital when they need it, allocation of that capital in an intelligent, efficient way, fantastic, and they need to tell people about it. So again, you can have screaming objections from some people either end of the scale here going, okay, you need to do better marketing. That's a fair question, but you need to do marketing, promotions and all that sort of stuff. I'll go, why are you spending any money at all? Because if we don't, no one knows where we exist and aren't going to buy the stock. But you shouldn't be spending any money on anything ever. And I don't think that's a realistic or understanding of the situation, okay? Because it's very competitive out there. Because there's already too many companies out there trying to, get after the same people. So that's something. So I think the don't spend any money is naive. I'll put it like that. There you go. There's a few hate emails to me. But the people who are saying, well, you can spend your money more sensibly, I get that. Because I've seen, and you will have seen, and you will definitely have been offered probably 5 times a week, deals from lots of companies promising the world about what they have got and what they can do for you and, what you're missing out if you don't do it. And money charge ranging from a couple of $1,000 a month to $300,000-$400,000 for a 3-month contract. Even now I'm I'm in the wrong game here. I wish I could do that, and I'll give you that. I've got an actual example. There's 2 uranium companies, and they did the same thing. Just keep it at home with you and me. 10 million market cap at the time, not much different, maybe double that now. Spent $400,000 on a marketing campaign to do social media, to do some tweets and some videos which they could tweet out to an audience in North America. Did nothing for them, but they learned the hard way. And it's from a point of desperation, I guess. But I think that's quite exceptional set of balls on that individual to even think that was a reasonable allocation of spend rather than putting money in the ground, knowing what we've got to spend, as you just described, in terms of just keeping a public company going. So don't worry about the digging, don't worry about the drilling, don't worry about any kind of surface work. Just spend it on marketing. I think that's a red flag for me all day, every day.
So I mean, there's a trade-off here. You talk about your management team, and I think in my mind, an exploration company is a perpetual startup and needs to spend and think like a startup, right? Where every dollar is going. But we're a public company, so we've got, we've got a lot of people looking at us that we don't normally have looking at us, and actually managing the capital markets end of this thing is like a different business from the one that you're doing out in the field every day. And again, you're looking at an organization where there's only 1 or 2 people actually doing everything, chief cook and bottle washer, as opposed to, like I say, a Cameco or somebody else who's got teams of people that focus on 1 or 2 things. So, what is the right price to have somebody sitting in that chair that actually understands all of that stuff? And in half of the case, they're actually the geologist. So they're they're coming from that end of the world, and they've got a board of directors, and they're sitting in the capital markets, maybe for the first time, maybe for the 3rd time, getting yelled at because the stock price is down, and they don't know what to do. And I've seen that in many cases. Very brave people who just, it's not like we've got a knob sitting there and we can turn the price up on our stock. So they start doing whatever they can. And the landscape has also changed in the last 10, 15 years. It used to be I could go out and do a road show and hit every broker and dealer I could get my face in front of, and they would tell their clients and so on and so on. They're not allowed to do that anymore. So that approach just doesn't work. It doesn't get me to the retail people. So now I've got to come up with a different way of getting to retail. Well, is it going to be Twitter? Is it going to be, Stockhouse? Is it like, what do I do? And that's where you've got this field of IR people banging on your door saying, I can move your stock. I can bring in people. I can do this, that, and the other thing, $10,000 a month. And I've seen situations where some poor schlep, bright as hell, knows what he's doing from a business perspective, has got 8 contracts sitting in front of him and paying each one of them $10,000 a month. No idea what's coming out the other end, because we're dealing with something that you can't measure directly. This isn't advertising like we're selling a product. This is just getting awareness around a stock and what we're doing, and it's daunting. So a lot of people are doing this stuff out of sheer,
Panic
and not knowing what else to do. Because
I take that. Not all juniors can afford all the people at the level they need day one. So some poor sod is laboured with, I say, chief cook and bottle washer title, for sure. And I guess that's where the mistakes are made. And ironically, at a stage where the company can least afford to make those sorts of mistakes as well. So that's why it's, I guess, doubly imperative that they get help, or they don't know, talk to each other, or I don't know.
What's disappointing is that when they do get a bank full of money, right, and it usually comes in increments of millions of dollars, all of a sudden they just start spending it, and be it on what they perceive as being IR communications, or what they perceive as being the right bottle of wine that they deserve at this point in life. I don't know, but that becomes a problem.
But here's the other thing, just on that as a kind of derivative of that conversation, which is you talk about, we need to be entrepreneurial, right? Except you're in the public market. This is what amazes me. It amazed me when I was in banking, and it's still amazing me to this day, that companies just, your first kind of go-to for most guys is, I've got an idea, let's go public, right? Well, I've got a great asset, let's go public. No one's putting risk money down. It's not even a consideration, right? No one's putting their house on it. No one's really saying, I'll sell my car, or I'll move into a smaller property, or I'll forego the holidays or whatever, and I'll put some of my own money in this. It's just, let's go public. And if it doesn't work out, at least you've been paid for a while, and we'll move on to the next thing. And the chances are it will fall down, and they will have to move on to the next thing. For me, as a true entrepreneur, I recently, as you know, did this corporate project. I put 2.5 million US, whatever was that, 3.5 million Canadian, actual money, actual dollars, no sweat equity, no kind of in lieu of whatever the hell, actual cash, which I've earned and paid taxes on and then paid into this thing, at risk. It's like that. To me, that's entrepreneurialism. I don't think the Canadian public markets knows what entrepreneurialism is. I think maybe I can count on one hand CEOs who don't take a salary, for instance, which I'd say, well, I'll give you some kudos to that. Even if you put no money in, I'll use some kudos. But you are loaded up with options, fair enough. Your future success. Yeah, you loaded up some free stock. Okay, that's future success. I kind of don't mind that, but I rarely have that conversation with anyone. Which is the amusing thing to me, because I tell you what, if my copper thing fell over, I'm out of pocket 3.5 million Canadian dollars. No one's going to lose any sleep about it. No one cares. And if I told that story to people, it's like, well, that's your own fault. And that is, I think, what entrepreneurialism is. It's like saying, I'm going to give up something of value. Therefore, if I get it right, I should be rewarded. If I get it wrong, I've lost my money, my risk, my fault, my problem. And so the public market guys do have a kind of get out of jail clause there.
There's a disconnect. There's a disconnect between the investor and the folks running the company in most cases, right?
I agree.
So that I don't have to look into the eyeballs of the guy whose money I'm spending or losing, and it's not mine. So there's that, and I've seen a lot of these companies run where you listen to them talk, and there's just no respect whatsoever for the investor, for the money that's actually been invested and put into this thing. We got the money, therefore, we move on, as though it was, it was revenue. not investment. So that definitely we see, but again, it's nature, because you've got this disconnect. You don't have an investor looking over your shoulder in the same way as you do if in a truly entrepreneurial venture. The other thing too and I learned this in the venture world, is that there's really not a lot of value to be given to sweat equity, as much as, and people don't understand that. Well, certainly the people that are trying to build something, in their garage, or they found something, or they've put in months and months of time doing something. Unfortunately, as much as you may think that that's worth a lot, it's not worth as much as the guy who's actually writing a check.
Yeah.
That's different.
I'm afraid so. And the many times I hear that line as well. I put in $1.5 million. All right, how'd you work that out? How many actual dollars? None. But I worked really hard for such a long period of time, so therefore it's worth 1.5. Okay, on what daily rate are you working that out? And by the way, no one cares. So you've got stock as well. So you put nothing in, but
it's a sunk cost in our world. Yeah.
Yeah. So, that welcome to the world of, being a true entrepreneur. Don't whine about it. Okay. So like a lot of things there, I think, which, like I say, people will agree with, people will disagree with. Okay. Don't sit there nodding, be angry. Just, write to us, tell us why. We've even published articles from people who've kind of given us some sort of coherent, logical argument, for or against the topic. No one's wrong. It's just, your thoughts.
Well, the other question I would have for people watching is do they know where to get all this information? There's a lot of information that is available.
Let's get on to that.
Right.
Let's get on to that. Okay, here we go.
There's a few things. I mean, if you can look, obviously you can look at a company's website and you're going to see whatever they've chosen to put on there. They don't put everything on there, but you'll typically find most of their press releases, the good ones, but you'll find their financial statements, etc. There's the management discussion and analysis document that goes out every quarter with the financial statements. Actually, I know a lot of people, and that's all they read. That's what they'll do. Every quarter they'll read that, because it's quite an extensive document that we require to put out. It explains all the movement in the numbers in the financial statement. It also explains all the work that we've done over the last 2 years on any of these projects and what we've been doing. So it's if all you're doing is living off of press releases, you're living off of only the best of that we want you to see and hear about. But those documents will give you a more consistent, fulsome understanding of what the heck we're up to and have been up to for the last couple of years.
And what can people typically expect to find in them? For people, I'm talking about the audience who have not gone in. Most people do live off the press releases, and life is shiny and unicorns will be presented at the next quarterly. But what do you actually see in here? Because it's everything's regulated, but this document even more so comes under some level of scrutiny, because it talks about what the exchange expects you to talk about. Press releases and websites are, what they say is going to be true, but what they don't say is also
they're regulated as well, right?
I mean, they're not obliged to talk about certain things on their website or the press releases, right? So MD&A is much more important. So what do you look at when you get into that?
Well, when you're getting into those, now you're looking at it's an analysis of the financial situation typically. So they have to explain what you do as a business, why you're there and why you're out there. It has to explain all the line items on the financial statement and what it means and why it changed in the last year or didn't change in the last year. It has to explain, the big thing with a resource company or with an exploration company is you have to go through all of your projects and explain all the work that's been done over the last 2 years. So there you're seeing the full story in a proper lineup, as opposed to the spotty news that comes out every once in a while that we've started drilling, we finished drilling, we've done this and that and the other thing. Those are the big things that come out of the MD&A is really what we're doing. And if you look at, typically a smaller resource companies like ourselves, there's a bit of a template going on there. So what you're seeing from us is, our minimum requirement to get to put in the document. If you go to a Cameco or a bigger company, that document becomes quite a tome. and or even when you get looking at the developers and some of the producers, you're going to get just a ton of information about the market, about what their expectations are, what their stock has done over the last year, why it's done that, and a lot of general industry stuff as well. So it's a source of information that a lot of people overlook.
Absolutely. So you see a lot of numbers in there and laid out usually quite nicely. I wish there's a bit more standardization of how the companies lay the information out, but also, they're obliged to talk about some of the risks in there too. So it's definitely,
right.
If you've not looked at one, get into the company's website, or you can get it from where do we get Sedar?
Well, Sedar is the other thing that people should be taking a look at, and I don't know whether people realize that that's so. Whenever all these filings and statements and things, when they say we have to file things, what we're doing is we're actually posting it on a website called Sedar, SEDAR.com. And everything goes there. Our prospectuses, our technical reports, feasibility studies, like financial statements, and all of our press releases have to go there. So there's stuff there that you're not going to find anywhere else as well. Anything that we've ever had to file, if you want to look up the history on a company and see what's gone on and how many times it's changed its name and how many times it's done a consolidation or all the bad press releases that they didn't want to put on their website, it's all there for public access.
Yep. Yeah, I think that's true.
Now, what you'll also find there, I should mention, is your management information report. So, on an annual basis, when you've got your AGM, your shareholder meeting, you have to put out a circular that describes a whole bunch of things, which is how many shares all the directors hold, how many shares all the major executives hold, what they're being paid. If you want to know what a CEO or a CFO or what have you is being paid, it's in that document. And it's not just delivered to shareholders, it's available on Sedar to anybody who wants to poke around and see what's in there. All the things that are being voted on. There's a real dearth of information in there that goes down even another level.
Yeah, no, I agree. And like I say, I always kind of look towards some of the negative things, because even when it comes to issues around risk, liquidity, solvency, etc., capital resources available. Obviously, if it's an exploration company, you expect those things to be going from quarter to quarter. And question, well, you've got a sense of when they're going to need to raise capital. That's quite good investing info. Or if they've got capital, how quickly they're burning through capital, because it gives you a sense if they're sitting with $20 million that for that quarter, but they're burning through $5 million per quarter. That by the end of the next quarter they're going to need to raise capital again, and you can play that game, because obviously public markets react very, very differently to impending raises, and even post raises, a little dip you can play.
And the last source of information I'll mention is SEDI, so SEDI.ca. And this goes back to, you want people holding onto their shares and not selling or buying or whatever they're doing. What is on SEDI is any insider of a public company has to register on SEDI. And an insider is not just considered somebody who's got some information, but anybody in the C-suite and your directors, your CFO, anybody who holds more than 10%. We have to go in there on any transaction involving our shares. We have to go in there and register it. If we're buying 10 shares or 50 shares, or we get issued options, or we're involved in a financing, or we're selling off or buying up on the public market, all of that stuff has to be reported there within 5 days. So it's available as well.
It's pretty cool to be able to kind of see what the directors of the company are doing, if they're buying stock, not buying stock, selling stock. Why?
Just how much they hold. They hold out of the gate.
There you go.
Yeah.
You get it. All of this stuff's quite useful to kind of get a measure of the people that are making the decisions, because sometimes you get a real sense of. I've got this phrase. I always say, "Desperate people do desperate things," which means, sometimes people don't make the right decision for all the wrong reasons, right? Or is that right? Yeah, they're looking after themselves, is what I'm trying to say. And I've seen that so many times, where, people quite correctly point out, well, this guy's hasn't bought a single share in this company ever. Well, guess what? That's because they don't have enough spare cash, because I don't know, they're living a very lush life and spending the money on, well, I better not be rude, spending on money things that they literally can't afford, therefore, and deciding not to buy shares. So you know what's important to them. Therefore, I get a sense of the character from that.
Or they already hold a lot of shares.
Or they hold. Yeah, there's lots of versions. All right, go through it. Then you've got people who hold too much stock, and they in a position where by they're overweighted, shall we say? So you've got to look at what stock they hold elsewhere, and if they hold stock elsewhere. But I like to kind of get a measure of a person by how much stock they hold in any one company that I'm invested in, because I want to know when they say, "Oh, I'm aligned with shareholders," what they actually mean. Because that bullshit phrase has been used too often for my liking. Because 9 times out of 10, they are not aligned. They're also picking up a salary, you're also picking up a consultant's fee, you're also given like additional options, depending on what milestone of great note they have achieved, usually not of great note, by the way. So it's all loaded up in their favor. And that's why I say this transparency is required, so that you know exactly the tenor of the individual you're talking about, how they're incentivized, because it's that old adage of, show me the incentive, I'll show you the outcome. Never truer than in the public markets. So I don't know if that'll ever happen, but we can wish. There you go, rant. Several rants today. Then they won't stop either. Present company excluded. Right. So in terms of, I think the question we were answering was, or the topic we were answering was basically, how do you judge and how should you view the spending of junior exploration companies? And the answer seems to be, it depends on which side of the fence you sit, and how you view these things and how you value each of these expenditures.
And that's a good point. It does matter how you view it and how you value it, because what should people be paid to run these things on behalf
of. What's a reasonable salary? What's a reasonable salary, Chris? You tell me.
Well, I can tell you that probably the average salary in the companies we were looking at is about $200,000 for a CEO.
Okay.
And in a lot of cases, these are people that could probably be doing more than that elsewhere, but there may be options or equity involved. There's also, but when you start looking at it, it's not that wide a range. I mean, it's fairly narrow, but it's very quick to identify the ones that are outside of that range. I mean, we've seen some where, people are getting paid $500,000, $1 million, $2 million. Justify that in what I like to think of as a startup always. How do you justify that kind of stuff? And that information is all out there and publicly available.
You can't justify it, Chris, though.
No,
it's ludicrous. I've seen people, last year spoke to at least 3 guys on 800-ish grand all in on a company less than 20 million. I'm like, you've got to be effing joking me. I mean, go away, and they do not get my money, because I know what they're about. They're about them. They think that the ego is in the room. The ego has landed.
But who do you blame for that? Is it the individual? Is it the board?
Well, the board, come on, these small companies, the board is the CEO usually, right? Is the CEO.
Right, and that's what you want to determine as well.
Let's be clear about this. What happens with these small companies is the CEO comes up with an asset and says, right, let's put this thing together. Hey, buddy, would you like to be chairman? You pick up a stipend from us for doing not a lot of work. Hey, do you want to be on the audit committee? Yeah, basically, I don't really want to hear from you. That's the way it works. That's the way this stuff goes down with not all companies, but way too many companies. One strong individual controls the roost, controls the dialogue, the narrative, the actions, and the reporting. And that individual tends to be quite influential, shall we say, on the consultants that they hire later down the line, where, hey, do you want a gig with us? Can you write up a 43-101? Here's what it needs to say. And there's your check. That happens far too often in this game.
You're not wrong.
So no wonder this sector is basically screwed itself up the what, because of people like that. Now, there's a lot of good people in this space, but not a lot as a percentage They know the game. They know how to play the game. We say if you don't know the rules of the game, you can't play the game. And these guys know the rules. They bend the rules, and they enrich themselves. Again, beyond infuriating. Beyond
But they're not
infuriating.
hard to identify.
Good.
That's right. I mean, if you spend, I mean, again, we're dealing with we're dealing with an investment that is, you know, is what it is. And if you're not going to spend the time understanding what it is you're investing in this stage, then you're just gambling. And it's not hard to figure out who's on the board, what other public companies they sit on the board of or run. It's very easy to start seeing the connections between all these human beings. You can see what they get paid. You can see what shares they've got, what they paid for those shares. I mean, you can figure some of this stuff out if you spend a little bit of time poking around.
Or just call me, because I'll tell you.
We're just calling that. He knows.
I do. I say that quite a lot. I spoke to two fund managers on Saturday morning, separately, not together. And they just want to know the kind of lay of the land, and they say, is this company investable? And I'll go yes or no. And I'll tell you why. I've no problem doing that. I've done that with individuals, and obviously when we ran the kind of Opens app project, I speak to people on most weekends and help them avoid some of the shysters out there. And there are a lot, and as you say, easy to identify. They have a track record of just doing the same thing over and over. And eventually, one of the things comes off, and it more than covers the cost of things that didn't. But if lots of people get screwed along the way, and again, just really irritating. Really irritating. Ruins it for the rest of us, right?
Yeah. Well, yeah, for sure. Yeah. That's all. That's been the case forever.
Right. Well, so should we leave it to the room and say, right, guys, if you want to reach out to either of us, you can. If you want to comment to this, you can. You can contact me or Chris. You've got our emails. Happy to speak, but obviously probably I'm not going to put anything in writing to be used against me.
No, but and again, if you've got a sense of what should be right, it's pretty easy to identify the things that look wrong, that look out of whack. When I say how much money is going in the ground or not. We typically, I think on average, when we talk about, if you add up all this communication and advertising and IR and travel, it's about $600,000 a year, which is what these companies are spending on average.
Yeah,
that's probably not wrong. But that goes to say, if you see somebody spending $2 million, you got to really scratch your head and go, well, what do they do? And start looking a little bit deeper.
Agree with you. Well, should we leave it there? People love our ranting, apparently. That seems to be the impression I get. Love the rants. Please carry on ranting, because it's how a lot of people feel out there. A lot of people being burnt, a lot of people lost money, and perhaps some of them haven't done the work that they could have done. And even the ones who have, can get burnt too, because it's hard. It's a difficult space, but it's what you pick the right horse and you sit on it and ride that thing for a while. It's going to make you the kind of returns which you're just not seeing as a kind of retail investor generally on average.
But I mean, my last comment would be, but please, we can't run these companies on nothing. We can't stop spending money on overheads and salaries and people and things that we need to keep the world afloat. Because that we get that a lot is, how come?
Why are you spending money?
Why are you spending money? Period. And well, kind of have to.
Yeah.
Yeah.
And if we don't,
we'll die. We'll die.
Yeah. Slow terminal death. Okay. Well, Chris, as always, awesome to talk to you. And maybe next week we'll get back into uranium. It seems to be busy again out there, which is really nice to see.
Yeah.
I noticed the ISO deal. ISO Anfield. Yikes.
Yeah, that was too bad. That was criminal.
Yeah.
We'll see. We'll see what comes out. I mean, it hasn't. It's still there. I'm really not sure. What the objective was. They had one shareholder that was not happy with the price. So I don't know whether it comes back, doesn't come back. But for now, that was. I
hope it does. It just makes total sense.
Yeah,
it makes sense. To have the Tony M mine just around the corner, literally just around the corner, it makes total sense for them. If it's a game of like eking out a few more shekels from ISO, I guess that those are the challenges.
At that point, it's just math. to figure out whether it's worth it or not. I mean, again,
Yeah.
they've always got the energy fuels plant to back into.
Yeah, that deal's still there.
It's expensive, but again, now it's just it's going to be math after that as to whether it makes sense or not to pick it up.
I don't even think the energy fuel deal is expensive. I just think that is the cost and it's fine. But having Anfield would be better,
Yes.
obviously.
Yeah.
And I'm not quite sure who else it would be better for at a higher price, given where it is. So that'll be the interesting one. Well, there we go.
Yep, exactly.
Right, folks, enough of this. We'll see you next week.
Okay. Ciao.